platform. So just to give you a brief, so we are launching with Mirae Nifty 100 low volatility ETF. In fact, we've already launched it on the 13th of this month, which is on Monday, and the fund will be open till the 21st. So to take us through this fund and why probably in current market scenario this fund makes a lot of sense, I am joined by my colleague Vishal, who's part of the ETF product team with an overall experience of more than 5 years into building passive products. Vishal was earlier associated with NSE and was involved in product development there. One of the main person behind building this product. And Vishal, over to you. The request would be if we can take every participant, in the call to understand why we need a product like low volatility at this point of time, and what it constitutes and how this can add value over, say, a basic beta product like a Nifty 100 or a Nifty 50. So with that, over to you, Vishal. Thanks everyone and HDFC Securities for joining in.
Thank you, Laksh, and a very warm welcome and good afternoon to each and everyone. So I'll take you through the presentation about what we are covering today. It involves looking at the landscape of what this entire thing is, low volatility. I'm sure in last couple of years you all would have heard various terms in the market, like momentum, alpha, beta, for that matter of fact, value, dividend yield. In similar fashion, this is also one terminology that we talk about, which is low volatility. And this product that we are coming up with is Mirae Nifty 100 low volatility 30 ETF. The scheme will be replicating Nifty 100 low vol 30 index. Just talk about initially what is smart beta investment all about, right? So first and important step in understanding is that over the time, of course in last centuries also, the use of benchmark has evolved, right? Earlier it was used just for as an example of how economy is doing. Then it became a tool of benchmarking against the active fund manager. Then it itself became a product, right? A lot of passive product across the globe. Then you started having index covering across all the asset class, whether it's equity, fixed income, real estate, and then you started at more niche, more evolved product that started combining the benefits of pure play passive investment and pure play active investment into one product. And this is what we'll discuss about more in detail, that smart beta essentially captures the best of both worlds, whether it is passive investment or it is your active investment. And how does it capture it? So why do you invest in passive products? First, you don't want to take any active risk, the risk of fund manager, yes, but more importantly, you're also looking to evaluate or invest in a fund where you have a transparency. You know that this particular set of product is working on a predefined rule strategy, and that is one of the reasons of attractiveness of passive investment, right? You get the market return, you avoid the fund manager risk at a very relatively low cost, along with a transparent and rule-based framework. Whereas in case of pure active funds, you're looking at potential of outperforming the market. The active managers always try to exploit any kind of inefficiencies in the market. They use a lot of strategies to evaluate whether a particular set of stock has to be included or excluded from the portfolio. And one such thing is that a lot of active managers deploy the usages of what you call as factors in terms of identifying the stocks. Some of these factors more popularly are value. I think you all would have heard that value, momentum play, growth play coming into as a strategy from a lot of active fund managers. And these factors, if you remove it out from the active investment and you remove the rule-based nature, transparency of active or passive investment and club it together, you get a smart beta product, essentially combining the best of both the worlds. And over the time frame, what it has been, why it is important is that 50 years back, whatever the return generated was entirely attributable to the fund manager, right? Over the time, because of the academia, because of the evolution in the financial market, we came to realize that a lot of sources of these returns can be attributable to different factors, purely, let's say, taking exposure to market, picking a style of value or growth, picking a style of large cap versus small cap, can generate some of the returns. And that's why in last 20 years or so, smart beta has gained immense popularity across the globe. As of November 30, 2022, the AUM of entire smart beta ETF is roughly around 1.3 trillion. There are 1,275 smart beta products, which is almost um, one fourth of the total number of plain vanilla product across the market. And this is how the sheer number of volume that has grown into. Uh, Before we jump into individual factors, we just wanted to highlight, there are both advantages and disadvantages of doing a smart beta investment. What are the advantages? That probably once that was perceived as a source of alpha became started getting into converted to smart beta product, and because it got started converting to smart beta product, it is available at relatively very low cost. Investor can get the opportunity to avoid the fund manager risk and still continue to potentially keep his or her exposure intact. It helps in improving potential portfolio outcome and reduce volatility. And historically, most of these factors have reasonably outperformed their simple market cap weighted index in the long run. On the disadvantages side, I think it's very important to understand that factors are highly cyclical, which means that uh, whenever you're investing, you should invest with a long-term view, because in short term, factors tend to be very cyclical, specifically, let's say, like momentum. It works really well when the entire broad-based market is booming, or what we call it as bull market. Factors such as quality, low vol does exceptionally well in case when there is a lot of uncertainties in the market, and all those scenarios basically encompasses a lot of cyclicity that one has to allow its portfolio to absorb, so that long-term returns can be potentially evaluated from smart beta product. Second disadvantage is, unlike your broad-based index, which is sector diversified, naturally it is based on whatever is the highest ranking in cap companies. That is not the case in case of smart beta product. Smart beta product, a lot of smart beta factors are tilted towards certain section of stock, certain sectors of the economy. For instance, you'll find that a lot of low vol quality will have essentially a lot of consumer staple, FMCG, healthcare names forming part of the portfolio, which may be very different compared to the portfolio as provided by Nifty 50, right? Lastly, and very important, is that most of the smart beta strategies are based on analysis of historical data. In a sense that for last 10, 15 years, entire business cycle evaluation, it has been witnessed that these factors tend to help or generate that additional return that one is looking at, but it may or may not do so in the future. So with these three disadvantages, keeping in mind, now we go and jump into what are the factors specifically. So factors are nothing but, you can just think it of as a source of return, right? Like for instance, let's say your fund has generated a 12% CAGR over uh, 5 years time period. Now if you have to break up, like, from where that return is coming. So let's say during that same period, 9% of the return is generated by a benchmark. So out of that 12% which was generated, 9% I would have generated just by simply investing into the market. So one source of return is that 9% is coming from your market, and that becomes a source of a return, which is what we call it as beta, right? And the other additional layer of returns that one is looking to capture can be also explained through a lot of these factors. Two very important things to note while identifying factor, that it has to be consistent, which means that and why it has to be consistent is, again, we go back to the cyclicity of the factors. Because factors are cyclical, it is important to evaluate and check whether they are consistent over sufficient longer investment horizon. If I have to bucket what are the type of factors, then there are basically two group of factors: macroeconomic factors and style factors. Macroeconomic factors are nothing but something that we all are aware about, uh, where the market reacts to macro factors such as economic cycle, GDP, inflation, interest rate, or let's say as latest as collapse of SVB bank, right? So these are again all macroeconomic factors that are forming part. Apart from this, what you have is style factors, and this is what the emphasis of smart beta product is, that to capture factors which are beyond the macroeconomic. A lot of style factors which are very popular are low volatility, quality, size, value, momentum, growth, dividend yield, alpha. To explaining to you to each of these factors, value is simply you're trying to capture stocks that have lower price related to their fundamental uh, valuation. It really works well in the market, in the recovery market. It has a lot of cyclicity. We'll see that again. Low size is basically you're trying to capture returns of smaller firm outperforming their larger peer. Momentum is basically you're betting on the stocks that have done well in the past, will continue to do well in the future as well. In terms of lower, you're betting on stocks that have lower than the average volatility, and it does well typically when the markets are, in bear market phase or there is a lot of uncertainties across. Quality factors, you're looking at companies that are characterized by low debt, stable earning, and other quality metrics. It does well when markets are generally stable, robust, specifically during the time of just before or after the bear market one looks at. So again, to emphasize, as you can see right here across calendar year, different factors have performed differently. For instance, in 2007, value generated the highest return, right? Now you see in 2008, which is at the time of global financial crisis, low volatility has generated the highest return by not falling the most, right? You look at momentum has collapsed in 2008, in 2009, and that's how it is. When you have a good run up, so 2012, momentum did well, 2019, momentum did well, again 2020, during the time of COVID, which had impacted the entire market. What you are looking at specifically is low vol did well, quality did well, and more often than not in last 2 years, 2021, 22, low did not do well. So this is what we mean by factor cyclicity, that it is very important to understand. And why it is important is that whenever you're looking to make a smart beta investment, it should be from a long-term investment framework, so that your portfolio can tackle any kind of cyclicity, which will definitely come into your uh, framework of exposure. And this is what we talk about when we talk about cyclicity, that it's over the time period, that there are time periods like 2021, 22, for 2 years, the volatility has not done well between, if you see specifically value and dividend yield, they continue to underperform the benchmark or their previous heights by almost 3 to 4 years. So that's the kind of cyclicity that we are talking about. And now we are jumping on to the factor that is essentially uh, kind of the uh, talk of the product of Nifty 100 low volatility 30. The factor is very simple. What it selects is, let's say you have a universe of 100 set of companies. From there, least volatile stocks are selected and they are brought together to form a part of portfolio. In terms of uh, what are these or how are this calculated? Then simply it is a standard deviation, downside standard deviation, beta, and the other way of calculating lower. Now, a very interesting thought process or a psychological behavior is why low wall works. You see in the subsequent slide that low wall has done reasonably well over the long term, and the reason why it works is probably because of the lottery effect. Is that most of the market participants are busy in playing, the looking after the stocks that are too volatile, with the mindset that with a smaller payoff, with the smaller, by paying a smaller amount, they can go for a bigger payoff, right? And that doesn't work. And as a result of which, a lot of these low volatility stocks tend to be sidelined, and that's why they do well. Another is this skewness effect, and that we'll cover again later. Is that uh, because low volatility historically has displayed that it falls reasonably less compared to other factors, and during the time of boom market, it does not outperform the broad market, but it moves in tandem with the broad market because it has fallen a lot less. uh, that continues to get accumulated in the long run, and that has really worked well for low volatility factor. And the thing that I was referring up to here is this. Uh, Among all factors, if you see low volatility has the lowest drawdown. If you see, for instance, at the peak of 2008, 2009 financial crisis, momentum had a drawdown of almost 70%. Low wall had a drawdown of 40%. It has fallen almost from peak to high 30% lower compared to the momentum, and that helps in building up the product over the long term, even if it does not outperform on the broad market during the time of boom or rally. Coming up to the product, uh, the ETF is based on Nifty 100 low volatility 30 index. As the name suggests, it basically tracks a portfolio of 30 companies which are selected on the parameter of being least volatile in Nifty 100 index, which is basically your large cap space. So how does the composition of the index work? Is basically all the securities forming part of Nifty 100 are eligible. Then securities should have a minimum listing history of 1 year. Securities should be available for trading in the derivative segment. After this universe criteria, stocks are selected based on the volatility for index inclusion. The volatility is completed using standard deviation. Basically, after computing the standard deviation of all 100 stocks, I will rank them based on the least volatile stock getting the first rank, the most volatile stock getting the rank of 100. And from that ranking, I'll carve out and take just 30 stocks which are forming part of the portfolio. Now you might think that, okay, once this 30 stock is selected, then what? After that, on quarterly basis, there is something called rebalancing and review. The index team, or let's say the National Stock Exchange, was handling this index. They review the index on quarterly basis based on any revised inclusion, revised exclusion. They update the index with an inclusion and exclusion on quarterly basis. And why that is done? To keep the index relevant to its mandate. The mandate of the index is to track the least 30 volatile companies from the Nifty 100 space, and that's what it manages to do by rebalancing and reconstituting. Again, if you see, as compared to the other factors, whether it's your uh, alpha and compared to the broad market of Nifty 100, Nifty 50, the index has done better. Again, re-emphasizing that one of the reason why low vol does well is that historically it has exhibited a skewness tendency, which means it falls a lot less, as a result of which whenever there is a booming market, though it may not outperform the broad market, it may continue to give returns similar to the broad market, but because previously at the time of financial distress, at the time of heightened volatility, it has fallen a lot less, it tends to get accumulated, and that's what you can see here, right? That ultimately in the previous slide we see that on total return index basis, low wall in terms of value has far greater value compared to alpha, uh, Nifty 50, Nifty 100, and that is largely because of this reason that you are looking into, that is lower drawdown. In terms of performance, again, the index has a backtesting history available since 1st April 2005. So you're looking at a history of almost 15 years. As you can see clearly that the last 15 years, low volatility 30 has outperformed alpha 100, Nifty 50 by a good margin, right? But again, if you come back to it in terms of 5-year framework, that outperformance is reduced to almost just 1%, and that's what we have been referring into, that factors tends to be cyclical, so one has to allow a long-term investment horizon for it to play out on both the sides for it, because it's very tough to just capture the upside and let go of the downside. But along with the volatility, along with the return, what is quintessential a feature of low vol, as the name suggests, its volatility will be the lowest, right? If you're looking into in terms of volatility, what it has, then in terms of volatility, what it has the lowest volatility across the segment, and this is largely consistent across all the time frame. If you look on a 15-year basis, its volatility is 5% less than Nifty 100, with an outperformance on the return side. Again, if you look at various calendar years also, it has done reasonably well. But again, recounting the fact that it has fallen far less, specifically at the time of financial distress, which helps in building up over the time in the long framework if one talks about. In terms of not only periodic return that one looks at, but also in terms of on rolling return basis, if you see specifically Nifty 100 index where it outperforms is that on 3-year rolling basis, it has outperformed 84% of the time Nifty 100 index. On 5-year, it has outperformed 96% of the time Nifty 100 index. On 10-year framework, on rolling basis, it has outperformed 100% of the time Nifty 100 index. And this outperformance is what I think talks about in terms of where it is specifically and why one has to look over the long framework. Right? If you keep invested just for 1 year or 3 year, there is a probability of that it may underperform the benchmark index. That probability gets reduced. Of course, it is not that it will definitely outperform Nifty 100 or Nifty 50 index, but the likelihood increases once your investment horizon or the tenure, if you increase the holding tenure for the smart beta product. Why does it do well, right? And one of the reasons is that as compared to your existing benchmark, let's say Nifty 50, currently is skewed towards financial services. Almost 37% of it is towards financial services. But if you see the low vol product, it has a weight of around 13.2%. It is low vol is tilted towards FMCG, IT, healthcare compared to Nifty 50, and that's what it is. That you get, apart from returns and everything that we are talking about potential, uh, you also get to see direct alternate exposure in the large cap same space. And what are the companies that are forming part of the portfolio as on Jan date? You have Nestle, ITC, TCS, Bajaj Auto, Britannia, Hindustan Unilever, Cipla, L&T, NTPC, SBI, HDFC Insurance, Power Grid, right? Most of these names, I think, are known for their relatively less volatility, and that's why they are forming part of the portfolio. Lastly, the index has also done reasonably well against active fund management. If we compare it, for instance, on a 15-year basis, periodic basis, uh, Nifty 100 low vol 30 index, it has outperformed 100% of all the active funds that are there for last 15 years, and that too by a margin of 5.3%. Again, if you look at from the periodicity of 3 or 5 years, then it has done reasonably well, also giving investors an option to evaluate against a lot of contemporaries in terms of active funds which are available in the large cap space. Why we should consider investing in the fund? In short term, it can be an investment during the time of bear market, choppy markets, which we have seen. In long term, it has potential to outperform Nifty 100, Nifty 50 or longer horizon with higher risk adjusted return. We have already witnessed that over the time frame of 3 to 5 years, it has outperformed Nifty 100 on a rolling return basis as well, which may or may not come out to be true. But more importantly, across time period, we have witnessed that it has a lower drawdown. And why that is important, again, because it falls relatively far less compared to the other factors, broad market, it tends to accumulate wealth over the long time framework. Apart from your traditional advantages, what it also offers you an active alternate exposure and of course a viable alternative towards your large cap fund. Mind it, it's not a replacement of a broad market product. It is something that investor needs to know that yes, historically over long term, the product has done well, but it is exposed to cyclicity, which means there will be period of underperformance, and that will be sustainable in terms of it won't be just for 6 months, but it will be probably for a year or 2 years or so. So one needs to keep that in mind before investing into the product so that they can set around their investment horizon aptly for this product. So that's it in terms of product, in terms of the low wall construction and everything. The as Laksh pointed out, the NFO has already started from March 13. NFO will close on 21st March 2023. Listing will happen within 5 days from the date of allotment. The benchmark data is available on the Nifty Indices website, and you can check out independently. Nifty 100 low vol 30 portfolio. The minimum investment during NFO will be in multiple of 5,000 or 1 rupee, and there is no exit load, and taxation continues to be equity in this product. So thank you all for patiently listening to the product. Hope we have shed some light on what the entire talk has been on the smart beta, what are the different factors, what are the pros and the cons, and what are the careful points that needs to be evaluated before considering it. So thank you once again. Have a pleasant day, and I'll just hand it over to Laksh.
Yeah, thanks, Vishal. Thank you, everyone at HDFC Securities, for giving your time and joining us. The whole idea from our side was to bring in a product which, more often than not in current market scenario, not only looks at, providing return when markets are on one side, but also to, relatively conserve the downside to the maximum. But like Vishal mentioned, on the overall, still be able to beat the basic benchmark, which is say a Nifty 50 or a Nifty 100. So with that endeavor, we thought that probably this is a good time to bring in a product like this, and I hope basis recommendations from HDFC Securities, it will find some space into your portfolio. So with that, I would like to conclude. Thank you so much, everyone at HDFC Securities, for giving us the time and the platform. Please take care and stay safe.
Thank you, Vishal. Thank you, Laksha, for joining us.
Thanks.